It is Friday, July 10th, 2026. The bell hasn't even rung yet, and the implied open is already flashing warning signs. We're looking at the E-mini S&P 500 hovering just below flat, down about 0.14%. The Nasdaq 100 is slipping a bit harder, down 0.54%. And the Dow is just clinging to a slim green margin, up 0.13%.
Yeah, and if you look at the overnight session, the catalyst driving that slight Dow resilience is the shift in the geopolitical risk premium. It's basically evaporating.
Right, because of those U.S. and Iran technical talks.
Exactly. Those earlier jitters about the Strait of Hormuz clashes are really taking a back seat right now. Brent crude oil has cooled way down, trading right around that 75 to 76 sections a barrel mark.
And WTI is slipping under $72.
Yeah, so the immediate supply threat is off the table. But, and this is the critical part, do not let those relatively flat index futures fool you.
No, absolutely not. Because beneath the surface, the pre-market volume is telling a terrifying story about broad market fragility. I mean, let's unpack this missing liquidity. Thursday only saw 14.7 billion shares traded across the exchanges.
Which is a massive drop.
It's an absolute canyon. The 20-session average is 22.9 billion shares. That is over 8 billion missing shares. The S&P 500 closed yesterday right near 7,543.64, but there is practically zero conviction holding it up there.
Right. It's like walking out onto a frozen lake where the ice looks solid, but all the water underneath has completely drained away. You're suspended in thin air. And without that heavy institutional volume acting as a buffer, the algorithmic trading programs just completely take over.
Which sets up what the strategy notes are calling a coiling triangle trap.
Exactly. This is the exact opposite of a gap and go scenario. Structurally, if the S&P pushes up to test its overhead resistance today, which is sitting in that 7,590 to 7,600 supply zone, or even the 7,650 local highs, it is highly likely to be a fake out.
Luring in the retail buyers before the floor gives out.
Precisely. The positioning is so light that any sudden weight is going to crack the ice.
So if we aren't chasing the early morning green, we need to strictly define our downside risk. Let's get into the specific support levels. Where is the actual line in the sand for the S&P today?
Okay, near-term support is at 7,571. Below that, you have a structural shelf between 7,500 and 7,507. But the ultimate line in the sand, the trigger that breaks the bullish trend, is 7,460.
Because that's the 50-day moving average.
Right. If we lose 7,460, quantitative funds are forced to flip their programs. And for the Nasdaq 100, the upside resistance is stacked at 29,800, then the psychological 30,000 level, and above that, 30,200 to 30,400.
And on the downside for the Nasdaq?
The 50-day moving average support is at 29,674. If that snaps, the real structural base doesn't hit until 28,900.
Okay, so the clear takeaway for you listening right now is do not blindly chase momentum in this low-volume environment. But we do have massive pre-market gappers today. Institutional capital isn't just vanishing, it's aggressively rotating.
It's flooding into critical technology infrastructure, specifically AI memory.
Yes. Let's talk about the absolute monster headline catalyst today. Hynix, ticker SKHYV, making its historic Nasdaq debut this morning. The sheer scale of this print is unbelievable.
It's the second largest U.S. ADR listing in history, and the largest ever for a foreign company. They raised $26.5 billion.
Pricing right at $149 per share.
And it was 7 times oversubscribed.
But wait, let's look at the why here. We already have NVIDIA, Microsoft, AMD trading stateside. Why is Wall Street throwing $26 billion at a South Korean memory chip maker right this second?
Because of 2 massive structural factors colliding. First, the physical bottleneck in the AI supply chain. SK Hynix is the undisputed king of high-bandwidth memory, or HBM. They are NVIDIA's primary supplier.
Right. You can't run the world's fastest AI processors if you can't feed them data fast enough. They are the toll booth.
Exactly. And the second factor is this listing finally resolved the Korea discount.
Walk us through the mechanics of that.
Historically, massive U.S. funds face too much structural friction, trading directly on the Seoul exchange. You have opaque corporate governance, the dominance of family-run cables, foreign exchange risk.
Plus the geopolitical shadow of North Korea always looming.
Right. So global index trackers structurally underallocated capital there. But this U.S. listing opens a frictionless, dollar-traded pipeline directly to the core of the AI hardware supply chain.
Which means funds are basically mathematically forced to buy in to match their benchmarks. So looking at the tape, what are the levels for SK Hynix today?
The bull case says if it clears that initial $158 to $160 zone, it targets a fast run to $180.
And the bear case?
If algorithmic profit-taking drags it below that 149 IPO floor, it opens a trapdoor down to the $135 to $140 level.
And we can't ignore the ripple effect here. A debut this massive is forcing a direct reaction from its primary U.S. rival, Micron Technology, ticker MU.
Trading right around $991.64 in the pre-market.
And they are aggressively defending their perf. The strategy notes show Micron just bumped its U.S. investment plan up to $250 billion through 2035.
But look at the strategic pivot they're making with that capital. They aren't just fighting SK Hynix for data center dominance. Micron just secured massive automotive memory supply deals with Ford and General Motors.
Bypassing the crowded server market to lock in sticky long-term contracts for autonomous vehicles, that is a brilliant hedge. Let's hit the technicals for Micron.
If Micron breaks above $1,040 today, the structural target is $1,090.
But if it loses support at $949?
Then it risks a steep slide down to $900.
Okay, so that covers the tech infrastructure rotation. But let's look at the physical economy movers, because capital is also aggressively chasing efficiency and bracing for impact.
Starting with the small-cap biotech space, PMGC Holdings, ticker ELAB.
Screaming up 17% pre-market, and not on a drag trial result, but an SEC Form 8K detailing an internal merger of its subsidiaries. Just pure balance sheet efficiency unlocking immediate perceived value.
But the real macroeconomic reality check this morning is coming from the travel sector. Q2 earnings season officially kicks off with Delta Airlines, ticker DAL.
And the top-line numbers look incredibly strong. High summer demand pushed their revenue up 13% to $18.85 billion. But the actual profit projection is a disaster.
It's the defining theme of the quarter, margin compression.
Right, because they are projecting earnings per share to drop 29%, down to about $1.47 to $1.50. How does a company pull in nearly $19 billion with packed planes and still take a bath on the bottom line?
Structural overhead. Rising jet fuel costs are hurting, sure. But the real anchor is structural union labor expenses. Delta recently locked in massive multi-year wage increases for their pilots and staff.
So even with revenue up 13%, the cost to operate is vastly outpacing it. The margins get violently compressed.
Exactly. They are flying more passengers just to slide backwards financially. Delta is trading near $89 right now.
What are the breakout targets?
If the street believes their premium cabin margins can outrun the labor costs, a break above $93.66 targets $95.68.
And the downside risks?
If they lose $88, the momentum shifts sharply bearish, targeting $82.
All right, so we've got the low-volume S&P trap, the SK Hynix AI rotation, and Delta's margin squeeze. But to really tie this all together, you have to look at the invisible plumbing of the market today, yields and the dollar.
The macro setup. Because right now, the 10-year U.S. Treasury yield has eased down to 4.53%, coming off a peak of 4.597%.
And the U.S. dollar index, the DXY, has slumped from 101.50 down to 100.76, which, textbook speaking, is a massive tailwind for risk assets.
It lowers the discount rate for growth valuations and makes foreign earnings more valuable. But the institutional notes detail a concept that flips the traditional textbook logic entirely, the pain trade.
Right. What happens when this macro tailwind reverses? Because if the 10-year yield spikes back up over 4.60%, retail positioning historically makes the exact wrong move. Walk us through the mechanics of this mega-cap cash hoard squeeze.
When yields spike, retail day traders panic. The traditional logic dictates that higher borrowing costs crush tech valuations, so retail aggressively shorts the Nasdaq.
Assuming a broader market crash is inevitable, which honestly makes sense for debt-laden startups.
But it's financial suicide when you're shorting Apple, Microsoft, Alphabet, and NVIDIA.
Because they aren't borrowing money.
Exactly. They are sitting on hundreds of billions in fortress cash hoards. When interest rates rise, these megacaps generate massive, risk-free interest income.
Wow, okay. So they effectively weaponize the high rates. They stop trading like volatile growth stocks and act like giant high-yield savings accounts.
Yep. The broader index gets held up by their sheer financial gravity. And those retail investors who shorted tech, they get violently squeezed out of their positions by the exact companies they thought would collapse.
And the notes outline a second part to this pain trade, right? Over in fixed income, the bond bear trap.
Also known as yield capitulation. Retail sees yield spiking to 4.60% or 5%, and they assume the bleeding will never stop. So they panic sell their bonds right at the bottom, or even short fixed income ETFs.
Because bond prices fall when yields rise. But they're ignoring the institutional buyers.
Completely ignoring them. The moment yields hit levels that threaten the equity market, pension funds and sovereign wealth funds step in with massive size to lock in those high risk-free returns for the next decade.
The sheer buying volume causes bond prices to instantly surge, crashing the yields back down.
And trapping the retail shorts at the absolute bottom of the market.
Incredible. So putting it all together for you today, do not step out onto the thin ice of a low-volume pre-market. Wait for high-volume confirmation before you chase a gap and go. Keep your focus heavily on the institutional rotation into AI infrastructure, like the $26.5 billion SK Hynix debut.
And most importantly, do not panic sell into a macro pain trade. Let the smart money print their volume first.
No, I want to leave you with one final provocative thought to mull over before the bell rings. We just broke down how the world's biggest tech companies, the Apples, the Microsofts, are essentially using massive cash hoards to act as defensive interest-earning safe havens during high-rate environments. If that is structurally true, does the traditional 60-40 portfolio where you rely on bonds for 40% of your safety need to be completely redefined? I mean, are tech megacaps effectively the new bonds? It is something to watch closely as you trade today. Thank you for joining us on this deep dive. We'll see you next time.